First thing first, I want to take a look at why I actually like Palantir. Palantir was founded in 2004 by a billionaire called Peter Thiel. He was one of the co-founders of PayPal, and this is the same guy that actually gave Facebook their first check for $500,000. This guy knows a thing or two about funding growth companies. Palantir got his name from the movie Lord of the Rings. In the movie, if you remember, Palantir was an indestructible ball of crystal used for communication and to see events in the past and the future. According to Palantir's website, they build software that empowers organizations to effectively integrate their data, decisions, and operations. I like the sound of that, but it's a little bit complex. It's not as straightforward as you might want it to be. So in reality, what they're essentially saying is that they help organizations to bring together all their data. Various organizations generally have data in siloed locations around their businesses. Palantir is able to use their software to bring together all this data from various aspects of the business. It's amazing what this company has been able to do over the last few years. So far, their financial estimates have been right, and I expect nothing less from Palantir in the future. So when they say they're going to be able to achieve 30% annual growth, I believe it. Palantir is best known for its work with government agencies such as CIA and Department of Defense. They're also working with commercial customers like Airbus and BP. They also have NHS UK to count as one of their clients. The company is targeting approximately 6,000 companies with 500 million in annual revenue. So what they're looking for is companies that are earning above $500 million. Average customer spends about 5 million per year with Palantir. They offer 3 main software platforms: Gotham for their government clients, Foundry for commercial clients. The third platform is called Apollo, which powers Gotham and Foundry for their public and private cloud. It's a great data software that has been tried and tested by large enterprises, so it works. There's not been any major issues apart from one that was reported recently about a glitch, and it was nothing to do with Palantir. I've worked in software industry for many years. I strongly believe that Palantir can rival SAP. Many large enterprises use SAP for what is called ERP systems. So that's enterprise resource planning. This tool is very, very powerful. It enables businesses to be able to pull information together from various departments. So finance is able to talk with HR is able to talk to accounting. So they're able to share information in real time. So that's the power of an ERP system. We've seen oil prices fall over the last few years, but data is the new oil, and it's going to play a major role in our society for the next few decades. Palantir plans to grow aggressively over the next few years. The CEO, Alex Kapp, has mentioned that they do not care about any short-term profits and only focused on long-term growth. So as you can see, the company has an amazing story going for itself. If you didn't know about Palantir before, you certainly know now, and you're probably thinking, oh, why am I not investing in this company? I'm going to break that down for you in a second, and I'll give you my DCF calculation of why I am not investing in this company. The amazing story that you see so far is one of the reasons why you hear so many YouTubers talk about, oh, Palantir is the next $1 trillion company. Whilst I'm not here to tell you what to buy, let's look at some of the key statistical data that we have for Palantir, and you will see why I've made a personal choice not to invest in this company. Current stock is about $25 at the moment. They have shares outstanding of about 1.8 billion. Market cap is almost 50 billion. At the moment, EPS is negative. The company is not making any profit. You're only able to calculate PE ratio for a company that's making profit. Analysts are predicting that Palantir is going to grow at 50% annual growth. However, at the end of the day, they do have information that I might not necessarily be privy to. I understand that. So I do try to use their expected growth, but at the same time with caution. And that's one of the reasons why you see my margin of safety at 40%. So margin of safety is just to reduce your risk, to say that, well, I think it's going to grow at this rate, but at the same time, I have to take precautions. So what that gives me is my conservative growth rate of about 29.63%. This is very much in line with what the company has said. They've said they'll be able to grow at 30% annually. That's what the company has said. So analysts are believing that they will be able to grow faster than that for whatever reason. I don't know. I'm using a discounted rate of 10%. And the reason why I'm using 10% is because S&P 500 typically returns about 10%. So if I'm going to do all this work and do some analysis, at the very minimum, I want what S&P 500 is going to return to me, because I love doing this kind of analysis. It's not going to give me the same feeling as if I put my money in S&P 500. So I prefer to invest in individual stocks. But at the same time, I do have ETFs as well. So it's a combination of both. The bigger a company gets, the harder it is for it to grow. So that's one of the reasons why you see a growth decline rates of 1%. So I'm expecting that, as the company gets larger, they would decline their growth by 1%. You can always change that to 0 if you believe that they're able to achieve that 30%. This company has amazing balance sheet. As you can see here, they have about 2.5 billion in cash and equivalent. This company has a strong balance sheet. Total asset of 2.7, liabilities of 1.2, and that gives you a shareholder equity of 1.5. Debt to asset ratio of 0.43. This tells you that this company does not have to sell all its assets to pay for its liabilities. I really like this. So very, very strong balance sheet. Palantir is not profitable. They have a negative free cash flow of about 300 million. Free cash flow tracks the cash that a company has left over after meeting its operating expenses. It represents the cash available for the company to repay creditors or pay dividends to investors. Palantir has said that by the end of 2021, they are expecting a free cash flow of 300 million. So they're going to be positive by the end of 2021. I'm using a terminal multiplier of 20. I know this is high. A lot of people will use about 15, but for me, this company is planning to grow aggressively over the next few decades. They've said that they want to be the most important company in the world. It justifies paying a higher multiple for this company. Based on 300 million free cash flow in 2021, by year 5, they would have a free cash flow of over 1 billion. And discount that to today's value, you get about 700 million. And then that gives us a company valuation of 17 billion. If I'm going to be investing in this company for the next 5 years, I don't want to pay more than $9.17. By year 10, 2030, you're looking at 3.6 billion free cash flow. Discount that to today's value, you get about 1.4 billion free cash flow. That gives us a company valuation of 37 billion. If I want to invest for the next 10 years, I don't want to pay more than $20. For me, Palantir is a long-term investment. So the only time that I will be buying Palantir is when it's under $20. So now I'm going to give you my bear case scenario and my bull case scenario. It's not always going to be perfect. There will be errors, but this is my own assumption of what I think the company can achieve over the next few years. In my bear case scenario for 2025, I'm expecting Palantir to get to about 3.6 billion in revenue. And by 2030, I'm expecting them to get to about 9 billion in revenue. And that will give them an EBITDA of about 2 billion in 2030. In my bull case scenario, I'm expecting them to get to about 7 billion by 2025. And by 2030, I'm expecting them to get to about 38 billion. And that will give them an EBITDA of about 7 billion. The more a company grows, the harder it becomes to sustain. That's why I've added a growth decline rate of 1%. And that's why you can see all the way from 30%, you can see by year 10, growth has declined to about 18%. Now that I've shown you what I think the revenue could be over the next 5 to 10 years, I want to talk a little bit about what I think the share price could be over the next 5 to 10 years. For me personally, one of the reasons why I'm not investing in this company at this point is because I think over the next 5 years, revenue is going to increase, but share price is going to actually drop to about $12. But over the next 10 years, I think share price will also increase in line with revenue. So we could see the share price go up to about $50 by 2030. You will see that as part of my calculation, I have increased the outstanding shares because I do believe that this company will continue to increase the number of shares outstanding, which means that as a shareholder, we are going to get diluted. The main reason why the outstanding shares are actually increasing is not because the company needs the capital, it's simply because they are offering their employees a stock option. Over the next 10 years, I think Palantir will be able to grow in terms of their share price. So for me personally, I'm going to be taking a step back from this company. I'm not investing at this point, but I'll see what happens over the next few years. Maybe 3 years down the line, if revenue is growing faster than expected, I will reassess and then the prices could change. To conclude, there are a number of reasons why I'm not investing in Palantir. Number one, they're issuing way too many shares. Although this is a strategy to win the best talent to the company, it's not something that I personally agree with. There's been a 20% increase in the number of shares over the last 3 years. They had 1.6 billion shares in 2018. Now they have about 1.9 billion in 2021. This is too much of an increase for my liking, and I think it's going to continue for the next few years. Whilst I'm okay for a high growth company like Palantir to make a loss in the short term, I'm not okay with overpaying for a stock. The less you pay for something, the more you stand to make when you sell. As an example, if you bought 10,000 shares at $10 instead of $25, that's a major difference of about $150,000 in your profit. You make your money when you buy into an investment. Intel is a prime example of why you shouldn't overpay for a stock. Revenue was 34 billion in 2000 when everybody was excited and we had the dot-com bubble. Share price was around $70 at that point. Share price has never been able to recover, even though the revenue is more than double. So for me, I'm going to be waiting for this company to prove itself over the next few years and for the stock price to catch up with my valuation. Thank you very much for listening to this video. I hope you've been able to pick up one or two things. Make sure you like, comment, and subscribe. Until next time, stay curious and be happy.